All right, welcome everybody to Finance 443. This is week 3, which should be good news to most of you. If you're caught up in the course at this point, it means you're over halfway done with the coursework. Only got one more assignment, one more discussion board, and then one more test before the final this next week. Next week, we will spend almost the entire session covering the material that you'll need to know for the test. So we will spend a significant amount of time next week preparing you for that final exam. This week's exam only has 20 questions, but we will spend most of tonight on preparation for the exam. The way that this course is put together, there's so many different, links and different places to access material. Most of it goes back to Investopedia information for the Series 7 test, but it's been all over the place. And so because there's such a wide variety of different content, I'm going to really get laser focused on making sure that you're ready for the test this week, that you feel like you have the information you need to be successful. So I'm still analyzing last week's test. Some of you did very well. Congratulations. Many of you struggled. So don't feel bad if you were one of the ones that that it was a really frustrating test. As far as that glossary that was provided, it didn't give you word for word, definitions. It gave you a definition, and then it expected you to be able to extrapolate or understand the concept well enough to reword, the definition and be able to match them up. And for many of you, that was a real challenge, as well as a lot of the content. It was just a long test, and it had a lot of different content, covering a broad basis of information. So, Jack, you're not alone on that feedback as far as last week's test. I'm still analyzing whether or not there should be some kind of curve on it. Like I say, some of you did so well. If I curve it, we're going to be talking about over 100% for some people, and so I hate to do that. I'm trying to think through and analyze whether or not there are other ways to help some of you make up for a test that maybe you're not as excited about. Okay. Whoa, Jack, that was a real doozy then. Yeah, we'll like I say, I'm looking at it, and there might be a chance for some kind of curve on it, but we'll see. All right, so I'll get back to you on that. We'll make sure that you have some kind of feedback on what's going to happen with that, but it might not be for another day or two as I try to analyze what we should do going forward on that. That's fair for those who did very well on it. I'm concerned that I don't want to make it curve up, the bottom end, and not still reward folks who really must have put a lot of effort into it and energy into it to get the scores they did. Okay. All right. So that was last week's test. As far as last week's assignment, I'm still missing a handful of your assignments. I have been getting a lot more of the week 1 assignments, and those have been graded as they've come in. So I appreciate you getting those done. There was a few minutes where the week 2 assignment tab was locked out, so was the test, and both of them have been reopened, and were reopened shortly after midnight on Saturday, on Sunday, so that you could submit both of those. If you ever run into a situation where you can't submit an assignment, you're welcome to just email it to me as an attachment, and I can get, your score entered into the right place. If a test is closed, please zip me an email right away so that we can make sure and reopen. As far as last week's discussion board, I thought it was a good board. As far as this week's discussion is concerned, we're going to be talking a little bit about currency and currency trading, and I think it'll be interesting. Tonight, we're going to talk a little bit about currency trading, so it should give you a little bit of background before you get to the discussion board if you haven't already taken a swing at it. Michelle, thank you for an early post. We appreciate that. It always helps the rest of the class, I think, to see an example of a main post, that's posted early and done well. So good work on that. Any questions other than, the feedback on the test? Obviously, I think most of you are feeling like that was pretty tough. But any feedback other than that from last week, or questions or concerns that you have going forward? Okay, looks like we're doing okay. As far as the assignment for this week, the assignment for this week is a 3 to 5 page paper, same instructions as far as the content requirement, but a 3 to 5 page paper about the pros and cons of international investing. And there's a couple things, there's two different ways to look at international investing, and they are related. One is you could be an investment, a consumer of investments, like I am, for example, where I go out and try to trade into an international company. So, for example, let's say I really like Nestle. I think Nestle's a great company, and so I buy Nestle stock. Or let's say I really think British Petroleum is a great company, so I buy British Petroleum stock, or I buy Volkswagen, or I buy HSBC or Voya. There's all kinds of international banks, oil companies, manufacturers, food companies that are international firms, right, that I could invest in their stock. Another way that I could invest internationally is if I'm a business owner, I could expand internationally. And you are welcome within this week's assignment to explore either or both of those foreign investment platforms. Okay, so one of them's not the right answer. You're welcome to explore both or take on one or the other as far as business investing internationally to grow their business, or individuals investing internationally to diversify their investments and try to find opportunity within companies that are outside of the United States. Okay. So any questions about this week's assignment? Should pretty straightforward. Shouldn't be too difficult. 3 to 5 page paper once again, and like I say, about foreign investment, whether it be from a business perspective or individual perspective. There are some links to do some reading on and do some research before you get to that, so you should have a good amount of content. You're always welcome to Google a few other sources, obviously, to complement your research and to add to your content. Okay. And the last assignment, like I say, for those of you who are caught up, this is your last one. Just a reminder, and I think I've said this every single week, and we'll continue to remind those of you who are missing a few assignments. Assignments are worth more than a third of your grade. It's very difficult, if not impossible, to pass a class if you don't turn in your assignments. So please get your assignments in. I do accept them all the way up until Saturday at midnight at the end of the course. You won't get full credit if you turn it in late, but you'll get most of the credit, and that might be the difference of getting through the course and moving on to the next class or not. Okay, so get them done. If you get stuck on them or if you have any problems with the instructions, please zip me an email once again. I'll get right back to you, and we'll try to figure out what we need to do to make progress. You also could use the learning coach, who I still refer to as a tutor, Lindsay Haas. I'll be posting her information tonight, an announcement for this week as far as how she can help. And she's also a good resource. I don't know if any of you have used Lindsay yet. Tina, Michelle, Jack, Salinas, have any of you used Lindsay, if you're willing to share? Or any of the learning coaches? Okay. Well, feedback in the past has been fairly positive. Sometimes it's hit and miss with different people. Okay, so you've been able to use Melissa? Okay. Lindsay's very good. She's just very busy. So, if you don't catch her in her, little window of time that I post for her announcement each week, it's a little hard to get into her. Yep. How's Melissa been, Michelle? Has she been decent to help you out? Good. Good. I like to hear that feedback. I'll go ahead and get her that feedback, and they always appreciate it when a professor can give them the feedback that things are good and they do a good job. So I'll pass that along. I appreciate that feedback. Okay, so tonight we've got a couple key concepts that we need to review. Not a lot of content as far as the concepts that we need to cover. You all have reading and different other things some content that you'll be supplementing what we talk about tonight during the session with, as far as some links on this week under the week 3 link as far as readings and tools, and then also under the instructions for the assignment and the discussion board. I think both have readings. So there'll be plenty of content this week. I'm focusing my content tonight mostly on the key concepts that you're going to see on the test. Okay, so there are 20 problems on the test. There is one matching problem with definitions, like we had multiple of last week. And so it would be helpful, I think, to take a few notes tonight. Although after I'm done with the slides, we'll go through the topics on the assessment, and then you can again take note on what types of topics you're going to need to prepare for the test. Okay. All right, so we're looking at economics tonight, Forex or Forex trading, which is currency trading, and it also can be referred to as FX trading, and international investment. So you're going to get help, or a basis for this week's discussion board from our Forex discussion. You're going to get some basis and help with the assignment based on our international investment discussion. And as far as the economics piece, it just happens to be a large part of this week's test as far as the questions. So if you feel comfortable with economics, Forex, and international investment, you'll be in good shape for this week. Salinas, I'm still on that main page. Let me just switch to the next one. Let's see if it actually works tonight. Are you seeing the second economics page that starts with the Fed? Sweet. We're already, at least we caught it this time, right? I don't know why it does that. Now, are you able to see my pages now? Or me shifting between them? Okay. Okay, so you got that first main page. I think everybody already was seeing that, right? Now we're just beginning the second page. Yep. Okay. Good catch, Salinas. Appreciate that. Like I say, that was my one goal for tonight. Now that we've accomplished it, maybe we should wrap up early. It's been a successful night. So 10 minutes in, we can just wrap up and be done. Now we'll make sure and get you this content. Any of you, if you need to, I saw your comment, Tina. If you need to step out, at some point, no worries. Just step out. The recording will be posted later tonight, and you're always welcome to review it, of course. So if any of you need to step out early, that's just fine. All right. So when we talk about economics is a very broad topic, right? You can take multiple courses, multiple college level courses, 200, 300, 400, 500 level courses on just economics. And usually what they do is they separate economics into two main categories. You've got micro and macro. Anybody want to take a stab on which is which, or what do they mean? Microeconomics or macroeconomics? What are the differences between microeconomics and macroeconomics? Okay, so micro, or a prefix for something that's smaller, right? And macro, a prefix for something that's bigger. When we talk about macroeconomics, we're talking about like countries and their economics. We're talking about the world and the economics of the world. We're talking about broad policies that affect nations. So that's like your GDP, your gross domestic product, is a macroeconomic issue, okay? Or unemployment is a macroeconomic issue. You or I being unemployed is a microeconomic issue. It's our household finances, right, that are being impacted by unemployment. You and I are being unemployed, okay? So there's a lot of crossover between micro and macro, but macro is the large scale, micro is the small household or business scale economics, okay? Like budgeting is an issue for microeconomics. Budgeting is also an issue for macroeconomics, but it's an issue that countries, right, are legislating different budgets versus, an individual household, okay? So I've got micro and macro. Most of what the book, not the book, but what Investopedia is referring to when we look at economics for this week, and the test questions are referring to macroeconomic principles, okay? And one of the most important concepts to macroeconomic principles is the involvement of four main, you could call them participants, okay? So there are really three main participants. It's government, businesses, and individuals, okay? Three main participants in the economy. And we'll talk about each one for just a little bit. But I wanted to start with a concept of the Fed. And of course, when we say the Fed, we're referring to the Federal Reserve, which is an institution very closely tied to the federal government, but not a government agency technically. So the Fed, or its board of governors, with Janet Yellen as the chairman or chairwoman in this case. She's, by the way, the first chairwoman ever of the Federal Reserve. The Federal Reserve is perhaps the most powerful economic player in the world, okay? Most powerful economic participant in the world. And why are they so powerful? Because Janet Yellen and the Board of Governors within the Federal Reserve have the ability to increase or decrease interest rates to banks, okay, the largest financial institutions of the world, and they have the ability to increase or decrease cash or currency or money supply. Another way of saying it is money supply to the world. Now, they're not a global institution, right? The Fed doesn't, they're not the International Monetary Fund or the IMF. The IMF is global, right? And it represents a lot of different countries. The Fed is just our organization here in the United States that controls our money supply and interest rates. However, because the United States is the most influential and largest economy in the world, what the Fed does is watched very closely by the rest of the world and impacts very sometimes significantly what happens in all the other economies of the world when the Fed makes decisions. Now, does anybody want to take a stab at what the most recent decision, significant decision that the Fed made was in the past month or two? What is the most significant decision, or a decision, I should say, just what is the significant decision that the Fed made in the past few months? And it's the first time they've made this decision in 6 years. Anybody? So Tina, they actually raised interest rates. Jack, you're right on. They raised the overnight lending rate, or what's called the discount rate, associated with lending to banks. Okay, and they raised it from 0, which is what it has been for the last 5 or 6 years, to 1/4 point. Yes, Jack, good. So what does that mean? It just means that it didn't cost anything, or very little, if anything, for banks to borrow money from the Federal Reserve up until a few weeks ago. And then as of a few weeks ago, it costs a little bit, not much, but it costs a little bit for banks to borrow from the Fed. Now, does anybody know offhand what normal interest rates are for the Fed? So right now they're at 1/4%. What is the normal average long term for the federal funds rate? Maybe somebody can find it really quick online. The average has come down a little bit over the years because these last 5 or 6 years it's been so low, but the average prior to the last 5 years was closer to 4%. Jack, very close to 4%. So it's been higher at times, it's been lower at times, and the Fed uses the interest rate, this Fed funds rate, to increase or decrease the money supply here in the United States. Now, how does that work? Why does the interest rate affect the money supply? Well, if you increase the interest rate, you decrease the money supply. If you decrease the interest rate, you increase the money supply. So they have they're inversely correlated, as we'd say. Meaning, if I raise interest rates 1/4 point, like the Fed just barely did, I'm in essence tightening the money supply, because the money supply is greater the lower the interest rate. Now, for all intents and purposes, based on a 4% long-term average on the federal funds rate, 1/4% is still very low, right? In fact, significantly lower than the long-term average on the Fed funds rate. So it's still very low, but as the Federal Reserve raises interest rates, it in effect decreases the money supply. And money supply, especially within banking, tends to drive small business and business growth overall in this country. So if you raise interest rates too fast and banks stop, creating liquidity for business owners and lending lots of money to business owners like they're doing right now, then the economy will slow down, right? And there is always a risk that the Fed can raise interest rates so fast that they create a recession. The Federal Reserve can create a recession by raising interest rates too quickly. So they're raising interest rates very slowly in order not to push us back into recession like we were at just back in 2008, okay? In 2008, they lowered interest rates dramatically in order to help the economy, in order to increase liquidity and increase money supply to get business and unemployment back to where they should be. So unemployment's very low right now, and business is very good right now overall. There are different pockets that are very bad, but business overall is very good in this country, and unemployment is very low in large part because interest rates have been so low. So the Fed had something very significant to do with that. Now, our politicians will always claim responsibility for how good unemployment is, and they'll always claim responsibility for how good the economy is, when reality is the Fed has sometimes much more to do with that than our government. Okay? So if you're interested, federalreserve.gov, federalreserve.gov is a website sponsored by the Federal Reserve that gives a lot more information about interest rates, about money supply. It's got a lot of economic feedback and data. I think it's a very helpful and resourceful site when it comes to the economy. The Federal Reserve employs hundreds and hundreds of economists to gather information and to help them with their decisions. And so as part of that, they provide a lot of that information to you and I in the public, and it's free. So federalreserve.gov is a great resource, and the Fed is a very powerful institution that very few people understand, right? When we talk about Janet Yellen, and we see her on TV, she's not the most exciting person to listen to. She's very bright. She was a professor. She's very, very smart. However, she's not very exciting to listen to. So a lot of people see her on TV and just say, I don't even know who this is or why this is so important. Well, she's so important because she's the chairwoman. She's the chairperson of the Federal Reserve, which is, like I say, one of the most influential and significantly important economic participants in the world. Okay, so that's the Federal Reserve. That's the Fed, as we refer to it. The president appoints the Fed chairperson, and the Fed chairperson can stay in their office, at their post until they choose to retire. So Alan Greenspan and then Ben Bernanke and now most recently Janet Yellen have been the chair people that the president at the time of the prior one's retirement has appointed. Okay? All right. So that's the Fed. Any questions about the Fed? Anything we need to address further about the Fed or the Federal Reserve? Now, when we talk about the main participants here in this country, as far as our economy is concerned, we talk about government, business, and individuals. And when we talk about government, we're talking about the federal government, of course. They're the biggest player. They're the biggest spender. Then we've got state governments, county governments, city governments. We've got lots of different government layers, right, that are out there. And government plays a significant role in our economy. Nope, we're still on the economic slide. We're just talking about government now under the Fed. We just barely talked about the Fed. Now we're talking about government. So as far as government is concerned, like I say, we have these different layers: federal, state, and municipal, what we'd call municipal governments, counties and cities. And government is primarily, if we were to describe the different participants as net demanders of cash or money supply or net suppliers of money supply, government is a net demander of money supply. What does that mean? Well, in order for a government to operate, they are usually a borrower, a net borrower of money and money supply in order to accomplish what they're trying to do. Well, what does that mean? So a lot of people just think the government prints whatever money they need every year. Reality, there are very strict rules associated with what the government can and can't do as far as printing cash. And in fact, the Treasury only prints money in accordance to what the Fed, like we talked about before, what the Fed dictates. So as far as government is concerned, their main role is to collect taxes, right, and institute, government programs, whatever those may be, the roles of government. Now, right now, that amounts to just over $4 trillion in different expenses, and it means that, and we only bring in about $3.75 trillion in revenue from taxes. Okay, so what do they do to create the rest of that money? They borrow the rest of that money, and that's where our debt and deficit comes from, is that borrowing. Okay, so they're a net demander of money supply. They're not a net supplier, although they do supply some of the money supply. They're a net demander. Overall, they borrow more than they create and put out. Okay. Then you have businesses. When we talk about businesses, everything from General Electric to the small mom and pop business down the street. We're talking about all business to the person who sells Amway or Mary Kay right from their home. Which, by the way, lately I've been getting a lot more. Seems like there are a lot more companies that are, from home businesses, like Beachbody. I don't know if any of you guys have heard of that one. I've heard of that one a few times. Shasai chocolate, healthy chocolate. There's Jamberry. It just seems like there's a lot of different companies now that people, they've always been around, right? The Amways and Mary Kays, but it seems like there's a lot of new ones lately. But those are all businesses, and businesses are also net demanders of money supply in the economy, meaning they are net borrowers usually in order to grow their businesses. So a company like Walmart, as great as they are and as much money as they make, they usually in any given year many times will borrow more than what they create. They'll borrow in order to expand, and a lot of businesses are expanding, and so they have to borrow from banks or from individuals in order to grow their businesses. Now, when we get to individuals, that's you and I, right? We work, we take home pay, and what do? We put it in our 401ks or IRAs. That means we invest it. We pay it to the government in the form of taxes. We start businesses. We supply businesses with capital by starting them or funding them. And so individuals are the only participants on the whole that are actually net suppliers of capital or net suppliers of money supply to the capital markets. Okay? So you'll want to remember that when it comes to those three different, participants. We've got government, business, and individuals. Overall, government and business are net demanders of money supply in the capital markets, and individuals are net suppliers. Okay? Now, we need to talk about two different theories. There are three different questions on the test that refer to these theories, the monetarist and the Keynesian theories. Okay? The monetarist theory basically states that the money supply dictates how an economy is going to do. Okay? The most influential issue or influential factor on whether or not economy is growing or slowing is money supply. Okay? If money supply becomes constricted, then the economy will slow down or even go into recession if supply is highly restricted. As long as supply is high, then growth will be high. Okay? So that's monetarist theory. Has to do more with money supply. It puts a lot of weight on what the Fed does. Okay? A monetarist would think that the Fed really is dictating most of what happens as far as our economy is concerned. And then you have Keynesian theory, which has more to do, it puts more weight on what government does as far as spending. So if government increases spending and individuals increase spending, that helps the economy. If they decrease spending, then that decreases the economy and slows the economy. So let me ask you this. If Republicans are, if Republicans as a party say we need to cut government by a third, okay, so that we can balance our budget and lower the debt. A Keynesian would say, if you were to do that, what would happen to the economy? Does anybody want to take put a thought in on that? What would a Keynesian say if they think that everything is up to spending? Spending by government is significantly influences whether or not the economy does well or not. It would definitely put the economy into recession or even depression if you're going to overnight try to cut it by a third. Okay? Now, does that make sense? And a monetarist might say, if you cut government spending and at the same time increase the money supply by lowering interest rates or, doing some kind of quantitative easing, which is what the Fed has been doing with QEs over the past 5 or 6 years, they would say you can offset the decrease in spending with an increase in money supply and keep the economy going. But a Keynesian theorist would say, no, if you cut the government by a lot, you're gonna really, really hurt the economy and might even throw it into recession or depression. Okay? So they don't have to compete with each other necessarily. It doesn't always have to be monetarist versus Keynesian theory. But somebody who's Keynesian, and subscribes to that theory as the most important aspect of our economy will be tracking spending first and foremost, where somebody who's a monetarist will track money supply first and foremost. And they can be interrelated, and they can be positive at the same time and negative at the same time. They don't have to be conflicting all the time, right? It just has to do with priorities and how you view the economy and what makes the economy go. Okay? So before you get to the test this week, this is just, a little premise or preview on the test. Make sure that you feel comfortable, not that you've studied a bunch about monetarist theory and Keynesian theory, but just that you understand enough of the basics that you feel like you can differentiate between the two and what the two focus on. Okay? And because most of these questions come from the test bank from Investopedia on the Series 7 test, I would look up under the Series 7 test the difference between monetarist and Keynesian theory, and that's where I would start as far as getting some additional content on it beyond what we talked about tonight. Okay? All right. Tina, we're about to move the slides. Did we stay? Does everybody see the next slide with business cycles at the top? This is so exciting. I feel kind of lucky. Maybe I should go buy a lottery ticket or something. Well, I'm in Utah. I can't, but I feel kind of lucky, that the slides are working tonight. I should put my name in like a raffle or something like that, because I'm getting lucky this evening. All right. So some more economic principles that are going to be tested on this coming week in the test. The test is going to talk to you about business cycles and want you to understand what business cycles are. Business cycles are a reoccurring phenomenon within the economy. Okay, they're reoccurring because we're always either going up or down as far as business is concerned. Okay, now markets do this. The gold market does it. The real estate market does it. The stock market does it. They all have cycles. The business cycle is a little different than those different investment cycles that I just mentioned, in that we're just talking about businesses now and their cycle. So one of the things that we do to track business cycles is we track manufacturing indexes, meaning manufacturing and service indexes. How much are companies expanding or contracting as it pertains to manufacturing or service industries, which are two of the most important industries in the United States. Manufacturing becoming less, although still very important, and service industry always being huge. I shouldn't say always, but having come on the last 20 or 30 years as a dominant part of our economy, the service industry. So we track that. We track whether or not the service industry and the companies associated with the service industry are contracting, meaning are they getting smaller and spending less, or are they getting bigger and spending more? And that's what drives a lot of what our economy does year to year, is whether or not average business in America is getting bigger and growing, or whether or not they're shrinking and getting smaller. Now, as far as the cycles are concerned, you've got times of contraction and you've got times of expansion, but you've also got peaks and troughs, okay? Trough being the low point, peak being the high point, okay? But you don't sit at that high point or that low point for very long, right? You hit it, and then you immediately start moving a different direction once you've hit that, okay? That's just the directional change, the trough or the peak. But the 99% of what's going on in a business cycle is either contraction or expansion, okay? Expansion positive, contraction negative. Too much contraction leads to recession. Too much expansion can lead to hyperinflation. So one of the things that China has been concerned about over the past 10 or 20 years is they have significant expansion and growth going on in their country, and a concern of theirs is that that will lead to hyperinflation and create currency devaluation to a point where their currency will become delegitimized. And if that happens, like has just barely happened in Brazil with the Brazilian real, it really is devastating to your economy. Okay, it's very important to keep your currency in check. One of the reasons the Fed is so powerful, you might say, well, why would the Fed ever want to slow down the economy? Well, one of the reasons they would want to is if the economy gets too hot, grows too fast, it can lead to significant inflation. And so one of their roles for the Fed is to keep inflation in check and make sure that inflation doesn't take off. If it starts to take off, their job is to slow the economy and slow inflation down so that we don't collapse our currency, okay, or the US dollar in this case. So business cycles, remember 4 different parts. You've got expansion, peak, contraction, trough. And you keep going through that cycle. Different stages can last different amounts of time. You can have a long expansionary period, and then you can have a short contraction period. Or you can have a long contractionary period followed by short expansion period, okay? There's no predetermined length of time, but we do know, as we look at history, that we go through the cycle over and over and over again. 2008 is a good example of significant business contraction, right, in a recessionary environment like 2008. 2009, just a year later, when you take the whole year into perspective, was a significant year of business expansion. And then the last 5 years has been decent expansion. We are coming into a window here where people are worried that we might be just entering the early stages of business contraction. And that's something that economists are keeping their eye very close on to look at. All right, you'll also want to know what some examples of leading and lagging indicators are. What are we talking about lagging and leading indicators? Well, we're talking about the economy and the growth of the economy. What are leading indicators that would mean that the economy is starting to get better? And what are lagging indicators that don't really tell us, they tell us that what already happened. So let me give you one example of each, okay? And Investopedia gives you multiple examples, and I would encourage you to just look through those before you get to the test. Leading indicator example is the stock market. Actually, historically, the stock market is a good leading indicator of what the economy is about to do. People invest in the stock market because of what they expect the future to hold for those companies. And so because of that, many times it's a great leading indicator. Another example of leading indicator is housing starts. Housing starts is where you get, your licensing to be able to start construction on a home. People don't construct homes or don't construct homes very often if they feel like the economy is going to be poor, right? They don't want to get stuck in a brand new big home if the economy is going to be bad. So that's another leading indicator of the economy. A lagging indicator, and maybe this might surprise some of you, but a lagging indicator that's very, it's always been lagging indicator is unemployment. Unemployment tends to be very good, actually, at the start of a recession. And then toward the end of the recession, that's when unemployment gets its worst, okay? But unemployment gets its worst after the recession is basically already over. And you start to improve unemployment when the economy gets better. But one of the things that's kind of tricky is people will look at unemployment right now and say, well, we're not in recession. Look how good unemployment is. Unemployment's so low. Well, if you understand that unemployment's a lagging indicator, it doesn't really mean anything going forward, right? We could be in the midst of starting a new recessionary environment, and unemployment could still be very low because companies haven't reacted yet because it's a lagging indicator, okay? So those are examples of each. You'd want to know examples of each, at least as far as what Investopedia has to say about both of those before you get to the test, okay? Those are lagging and leading indicators for the economy going forward. 2 of the acronyms that the test does test you over this week and are economic concepts are CPI and GDP, okay? So what are we talking about for CPI and GDP? CPI is a measurement of inflation, okay? It basically measures a basket of goods and measures their pricing, how their pricing has changed from one period to the next. Why do we even care about that? We care about that because we want to measure how fast inflation is going. And we don't want inflation to go too fast. And we also don't want to be in a situation where we deal with deflation. Deflation is a negative. Hyperinflation is a negative. We want something in between. We want what would be referred to as healthy inflation, right? Low, steady inflation is healthy. Negative inflation or significant inflation, those two extremes are very unhealthy. So one of the main roles of, once again, the Federal Reserve is to try to measure what inflation is doing based on using measurements like CPI that give them an indication of whether or not pricing is going up fast or whether or not pricing is going up stable or staying still or going down. And they will react differently based on what that information gives them. Okay? So if one of the parts of CPI is food, for example, food's inflated pretty significantly over the past 20 years. But if one of the issues on CPI, if one of the goods is gasoline, gasoline's gone way down, right? Over at least the past 3 or 4 years, significantly down. It's a beautiful thing. I can gas up right now for $1.58 in Utah County. It's phenomenal. And so CPI, if it includes gasoline and food, it might show that there really hasn't been a lot of inflation. Well, you and I know that there's been inflation in some areas, but then there's actually been deflation in others, and overall inflation hasn't been very high the past few years. Okay? If you look at the whole basket. Yeah, Michelle, I'd just like them to give it to me for free, right? Give me 20 gallons of gas if I buy a Slurpee. I go to 7-Eleven, I buy a Slurpee and a donut, and I get 20 gallons of gas for free. When they start doing that, we'll have arrived. And if you run for president, Michelle, if you promise that, it'd be like elections back in high school or junior high. I'm pretty sure that'd be a good guarantee. All right. So let's talk about gross domestic product just for a little bit. Gross domestic product is just a measurement of the productivity, okay, of all the workforce here in the United States domestically. Okay, that's why it's called domestic product. Gross domestic product, products made, value created here in the United States. Gross national product is a little bit different. Gross national product, or GNP, measures all the productivity of all of your citizens. So no matter where they live in the world, it measures their productivity and is a measurement of all U.S. citizens around the world if it's the U.S. GNP. The most popular common number is to just use GDP, because we don't, the GNP measurement isn't nearly as helpful in most cases as GDP when you're just measuring what happens in the United States. But GDP, if it's positive, the economy is growing. If it's negative, the economy is contracting. So it's a very easy figure to just take a glance at and say, okay, GDP is growing right now here in the United States in the ones. Might end the year at like 1.8%. Well, that's not very fast, right? It's not great, but it's not contracting. And a lot of times where if the stock market's bad and people feel like, the economy doesn't feel very good, I'll ask them, I'll say, hey, what do you think, do you think the economy's contracting or expanding? And a lot of people say it's contracting, it's horrible. And reality is it's been expanding, it just hasn't been expanding as fast as we'd all like it to, right? So it doesn't feel as good as we'd like it to. And then, of course, GDP is the whole country, so you oftentimes will have pockets of the country, let's say, during the housing crisis, Vegas and Phoenix were impacted a lot more than Salt Lake City. Right now, Texas and Alaska are being impacted a lot more than Utah, because Texas and Alaska are big oil states, right? And so with oil down so low, those states are in a recessionary environment where Utah's not. A couple years back, if you lived in Michigan, right? Michigan was basically in a significant recessionary environment. They're still trying to dig out of that recessionary environment based on how manufacturing has changed, and how different it is today than it was 20 or 30 years ago in this country. Okay, so GDP doesn't mean that there aren't pockets of real strength and pockets of real weakness. It just means that it's just a measurement of the overall country, how the overall country is doing as far as growing or contracting. And then when we talk about unemployment, who knows offhand, does anybody know offhand, what do we measure to measure the unemployment rate in this country? When we say unemployment's, at 4.5%, what does that mean? Anybody want to take a stab at that? Yeah, it's in part a measurement of people who are looking for a job. What age do they have to be considered part of that number? I think you're going to want to know this for the test, actually. What age do they need to be considered part of the unemployment number? So it's two parts. People who are actively seeking work, already employed, so they're measured as already employed, actively seeking, and they need to be over 16. Okay, so kind of weird, Jack. You'd think it'd be 18, right? But that actively seeking part is key, right? Because a lot of people under 18 are not actively seeking employment. So this goes to that discussion that a lot of people have and argue about over whether or not the unemployment number is really that accurate, right? Because who knows really whether or not our surveys are accurate on whether or not people are actually looking for a job or not. You could have a 65-year-old that's actively looking that could be, that nobody's even counting. And you could have somebody that's 20 years old that lives with their parents that doesn't even care and doesn't want to work and isn't looking, right? That somebody just assumes is. So those numbers can be very misleading. The other thing that people will talk about a lot is underemployment. So you can have good unemployment, but you have a lot of people working jobs that they don't want, right? A lot of people with college degrees, for example, back in 2008 that were working in the fast food industry. Well, is that underemployment? Yeah, that's underemployment. Those are people who are overqualified and what we'd call underemployed. And then you've got people that have just become discouraged and give up on trying to find work. A lot of people get to their 50s and 60s, and if they can't find the next job and they feel like people are discriminating because of their age, they might enter the retirement early, not because they really wanted to enter retirement, but just because they're discouraged and don't think that they can find the job that they're looking for. Okay. Unemployment numbers do not account for those folks either. Okay. So underemployed and discouraged don't get counted. Okay. All right. So that's unemployment and how we measure it. Right now, unemployment is very healthy in this country. It's made steady improvements since 2008. But as we mentioned before, unemployment is a function or factor that is a significant lagging indicator, not a leading or concurrent indicator. So you can have great unemployment and you can already be in the throes of the next recession, okay? Because it tends to lag what happens in the economy. Okay. Any questions about those economic principles? Salinas, I think that you are not alone. I think that if I were to take a poll of the 27 students in this class, I'd say probably half of them would say, I feel underemployed, right? I want more from my employment. I feel like I'm overqualified for what I'm doing. And sometimes just getting a degree like you're working on right now is the difference of making that progress that you want to make, that next step. All right, let's talk about Forex for just a minute. I don't have as much time as I wanted to talk about Forex, and then we'll talk about regulation for just a second. Regulation should be a little bit of a review from last week for you because we spent a lot of time talking about regulation on at least the assignment anyway, for last week. So when we talk about Forex trading or FX trading, a lot of people, their only experience with foreign currency trading just is like an infomercial that they heard in the middle of the night about somebody suggesting that we sign up for currency trading because it's this great market that never closes and we can make all kinds of great money and it's so easy to make money. I haven't seen as many of those infomercials over the last few years as I did a few years back. It seems like they were everywhere. It seems like people were advertising on billboards and signs on the street to trade currency, and that currency trading was just the easiest and best way to make lots and lots of money. Well, the part that they didn't explain is currency trading usually is leveraged trading, meaning usually you're doing a function of like 10 times your money or 100 times the money that you put in. So it makes your gains seem much greater, right? It enhances your gains to be levered like that, but it also can lever your losses, meaning if you're 100 times the money you put in as far as the gain or the loss associated with your trade, Well, if I put $1 in, I could have a gain of $100 if it's 100 times, but I can also lose my money very, very quickly, in that format as well. Okay, so it can be a high risk, trading. The biggest issue, the currency market does not exist for people to speculate on currency trading like those infomercials, are purporting. The currency market exists because different countries have different currencies and they have to trade with one another, and businesses interact in different countries and have to exchange with one another in order to have currency that they can use in the country that they're domiciled. So if I'm Coca-Cola and I have lots of business operations all over the world, right? Everywhere in the world has Coke. Well, I've got to be able to take the bills that I get in China, the Chinese yuan, from the Chinese there, and my operations there, and I need to convert them back to dollars so that I can use them to grow my business, advertise, and do all the things I do for my U.S. based, company. Okay, so most of the currency exchange that occurs has to do with investment banks transferring and transitioning currency on behalf of companies, institutions, and governments. Okay, a very small portion of the trading that goes on as far as the exchange from one currency to the next has to do with people speculating and trading like they advertise to do to make money. Okay, although that's part of it, it's a very small part of it relative to these institutions exchanging money because of the business that they perform around the world. Okay, now when we talk about total currency trades, it's always a 200% total amount of trading. Why is it 200%? Why is it twice what we normally, usually we say, you got to have 100% of something. 100% of all the trades that happen in the world in currency makes sense in our minds. The reason it's 200% is because currency is always traded from one currency to another. Okay, so each currency transaction has two different currencies trading. Okay, so out of the total of 200% of all the trades that happen in the world, 85% of them, or almost half of all the trades that happen in the world, okay, even though there are hundreds of different currencies, almost half of them are in US dollars. Almost half of them are either, going into US dollars or out of US dollars. Okay, so US dollars are a dominant driver and a dominant force in the Forex marketplace. The next highest one, I think, and I'm just remembering off a chart I looked at a few years ago, but the next highest one is the euro, and the next highest after that is the yen. And the euro and the yen are like in the 20s or 30s. Okay, not even close to the 85%, of the total of 200% of all trades that the U.S. dollar is. Now, could the U.S. dollar lose its ground and go down? Of course it could. And over time, as these emerging markets grow, it probably will lose some of its dominance. But I mentioned on the discussion board this week, Ron Paul's been talking ever since I can remember about how the dollar is about ready to collapse. And in fact, over the last 5 years, the dollar has done nothing but strengthen relative to other currencies in the world. And so you have to start to analyze that and say, okay, what are the real risks to our currency, and where, when it loses its dominance at some point in the future, which it very well might, does that necessarily mean depression here in the United States? Because currency is very important to a local economy, but it's not everything. You've got economies like, for example, China, who don't have a very strong currency. They represent about something like, the last number I saw was like 3% of all the world trading out of 200% is in Chinese currency. Yet they're the second largest economy in the world. They're growing very, very quickly. They've got robust growth. So obviously currency isn't everything. It is significant though for our economy here in the U.S. Okay, how significant? I'll allow you guys to kind of decide and discuss that. And how much risk do we have to the currency really falling apart? That's another issue that is a lot more broad than what we have time for today. But it is important. I was going to talk about the importance of the U.S. dollar dominance for our economy, and talk about a little bit more about that. There is quite a bit of linkage between our success as an economy and our currency and how dominant the U.S. dollar's been. And then, of course, there's this speculation that happens where people try to trade one currency versus another to try to get gains and make money off it. Can be a high risk, high reward, type of approach to investing. I just always try to make sure people understand the risks, right? Instead of just going in and thinking about the potential for gains. That's all we have time for on Forex. I wish we had a little bit more time. I wanted to talk quite a bit about international investment. I want you guys to make sure and do some research, mostly in relation to the assignment this week. There's not a lot of this on the test, so I'm not going to spend a lot of time here. But there are all kinds of different risks, and I want you to make sure with your assignment that you cover political risks in foreign country investing, currency risks that we just talked about, how one currency can change versus another, and that can be a very costly problem to have. If I operate in Argentina and the Argentina currency goes way down, and then I try to trade it back into dollars, I can lose millions of dollars on that transition from one currency to another. And in fact, on large companies, when you look at their financials, on their income statement, usually there's a pretty significant adjustment towards the bottom near their net income for currency exchange. And sometimes it's a positive. A lot of times, though, as of the last couple years, it's been a negative, because the dollar's been strengthening in a lot of other countries in the world. Their currencies have been weakening. And because of that, if you have international operations, which almost every big company does, they lose money on that currency exchange. Okay. There's liquidity issues, tax issues, and transparency issues in international investing, and I'd encourage you to consider all those risks as you write this week for your assignment paper. Okay. Just a real quick, the Securities and Exchange Acts of 1933 and 1934, and then the Act of 1940, as well as Sarbanes-Oxley in 2002, are all acts that the test will just make sure that you understand the basics on. Okay, you don't need to understand all the details on those acts, but there are some questions this week on the test as far as some regulation questions. Even if you have a resource that you can go to check the information on those different acts, the basics of those different acts, you'll be in good shape. And then make sure for the test this week, and this is kind of I feel like is kind of off topic a little bit of what we're learning about this week as far as economics and stuff like that. There are a couple test questions about FDIC rules. Okay, FDIC is the federal insurance on deposits. Okay, the depository insurance, the Federal Depository Insurance Corporation. Basically, it's insurance on our deposits at a bank. It covers you up to $250,000. It covers you on accrued interest payments. So if a bank defaults and you're owed, you have $100 in a savings account and they owe you $10 interest, the FDIC coverage up to $250,000 will cover both principal amount and interest. Okay, so it protects you. FDIC was highly effective, very, very effective during 2008. What do I mean by that? Well, we had a lot of banks go out of business. Hundreds of banks between 2008 and 2009 went out of business. FDIC had to come in on many of them and write checks to customers for the checking or savings account balance that they had, because that bank didn't have the money to make good on their promises. Okay, so just make sure you understand the basics of FDIC, what FDIC is, and you'll be in good shape for a couple questions on the test as well. Now let me just do a quick scan over the test, if you'll bear with me for a second, and let me make sure that I've covered everything that you need to know. FDIC coverage. FDIC is a bank-only instrument. It's not applicable to credit unions, savings and loans, thrifts. It's only banks. Keep that in mind for the test. FDIC insurance only covers savings and checking deposits, CDs, things like that. They do not cover investments like stocks, bonds, mutual funds. FDIC has nothing to do with stocks, bonds, and mutual funds. Okay. We talked about the 4 phases of the business cycle. Just make sure you understand what those are for the test. We talked about one of the things we didn't talk about. I've mentioned depression and recession quite a few times. Okay, depressions and recessions, and I mentioned the fact that if you have significant contraction in the business cycle, or even contraction in your GDP, then you're in recession, right? And even more pronounced contraction would be a depression. So depression's the worst, recession's bad, depression's the worst though. Okay, That's why when we talk about 2008, we call it the Great Recession, because it wasn't as bad as the Depression, back in the late 20s, but it was horrible. It was the worst recession we've had since the Great Depression. Okay? So recessions and depressions are significant contractions in the business cycle. We talked about how the business cycle is repetitive, right? We don't know how long each stage is going to be as far as contraction and expansion, but we do know that over time there's going to be this up and down cycle of peaks and troughs, contraction and expansion that happen over and over and over again. Has happened historically, will continue to happen. We want to make sure and understand, we talked about GDP and CPI, Consumer Price Index. We want to make sure you understand GDP and CPI a little bit, what we talked about there. There are 2 questions on the test about that. Want to understand unemployment. Who are we measuring for unemployment numbers? We talked about that tonight. We talked about what the CPI is measuring, how it measures inflation. What are they measuring to determine inflation with CPI? We talked about that. We talked about leading and lagging indicators and the fact that we need to understand and look at Investopedia as far as what they say about those two, some different examples. And then we talked about monetarist theory and Keynesian theory, and there are 3 problems on the test. I told you there would be. Actually, there are 4 problems on the test about Keynesian and monetarist theory. So please, please, please review those, refresh on those before you get to the test. We talked about net suppliers and net demanders of money. If you recall, individuals, consumers are the net suppliers of money, and government and institutions are the net demanders of money. So there's a problem on the test that basically says, does the government supply money? And your answer would be no, right? Individuals, by and large, are the net suppliers of money. We talked about how the Federal Reserve is in charge of the money supply and basically authorizing money printing that happens in this country, and how the Fed, has significant power in controlling interest rates and money supply in this country. And interest rates and money supply have a lot to do with the business cycle, right? If money's easy and money supply is high because the Fed's lowered interest rates, then that's an environment where the economy can really grow. If the economy gets growing too fast, what do? They higher interest rates to lower the money supply and slow it down so we don't deal with inflation. For the matching questions, you have 2 different matching questions, Michelle. One of them's about those economic, lagging, leading, indicator, matching. And then the other one is about the different acts. And I told you, the screen that we're looking at right now, 33, 34, and 40, as well as Sarbanes-Oxley. If you know the basics, what was trying to be accomplished from each one of those 4, you'll get those matching correct. Okay? All right, that's it for tonight. Any more questions about formatting of the test or anything else we can do for the test for you this week? Okay, have a great evening. Good luck this week. Let me know if you have any questions or concerns as the week goes on. Just send me a quick email and we'll try to take care of it. I'll be getting back to you. I'll probably announce and then email out feedback for the test last week, right? I committed to you that I'd keep analyzing that. We'll come up with some kind of way to either curve it. Maybe more likely what will happen is if you don't feel good about your test, we might find something else for you to do to make up some of those points, okay? So that you can effort some of those points if you need to. All right, have a good evening. Good night.